We've got some fresh new young talent doing some things that I know you haven't heard before.
1, 2, 3, listen.
Welcome to Finances, your home for all things financial, investment, money and lifestyle. Hosted and curated by the very talented team of certified financial planners at Burke Britton Financial Partners. Core topic today, we're going to talk wealth protection. So given that we've just been talking about injury, we're going to talk high level around wealth protection, what it means. Obviously, we could deep dive into every bit of this, but we won't. So we're going to stick to probably the maybe four key elements of wealth protection that we see the most. And then if we get time, the deep dive topic is around, well, sort of wealth protection as well, but wealth protection from a business point of view. We'll see how we go for time. So wealth protection. So, and this is straight off our website at bbfp.com.au. So wealth protection is about reducing the risks associated with accumulating wealth and protection of what you have already acquired. So simply, if you have a family who's financially dependent on you, or you have debts that need to be serviced based upon your income, it's pretty important to protect it. So when we talk wealth protection, again, some people have got a bit of an awareness, but it gets convoluted when you start to talk about the types of products that help people with protecting their wealth and protecting their families. But essentially, that's what wealth protection is saying, how do we cater for things if life goes sideways? Either I'm injured or unable to work, or permanently disabled, or a loved one passes away, or have some sort of traumatic event that causes significant hardship. And I suppose the thing that we know in Australia, we've talked about this a fair bit recently, is that it's a pretty expensive place to live. Like, the cost of living is enormous. And if you all of a sudden, as a family, without either an income source or the major breadwinner, either because they've passed away or they're out of action with disability, or you've got significant medical expenses, any of the best laid plans around growing your wealth can be thrown into chaos.
I think we gear ourselves up to that too, though, because we all want to have, the Aussie dream, buy a home. So you got a mortgage, people have debt, and they really line up all their obligations into a really tight-knit process. And if one part of that fails, pretty quickly things start to unravel. So if you don't have something to fall back on in terms of wealth protection, things get tight quickly. And I think because it doesn't happen to the majority of people, we don't really see enough of it to understand how bad it can be. And we're sort of in that position where we've seen it go pear-shaped pretty quickly for people. We've also seen where you've got your plans laid out that it can provide such a level of comfort, and you can take one of the biggest concerns off people's plate, which is financial security if they lose a loved one or they're impacted on their ability to earn an income. So I think probably just one thing I would want to note before we deep dive into this is that it's just a part of that plan, that wealth protection plan. And there's other things we've talked about in other podcasts about, having access to liquid assets, having cash reserves, having access to cheap credit or whatever that may be as a first instance. But these sort of things we'll talk about today are probably that next layer of, more serious events, I think.
Yeah. And I mean, one of the best ways to protect yourself financially is to grow your finances. But early on, so when people are in their sort of accumulating phase, that's predominantly where we see sort of wealth protection or insurances in that sort of wealth accumulation phase where people haven't actually acquired significant assets enough that they would be classed as self-insured, meaning that they've got enough money to draw on should they be crook or unable to work. But for accumulators, like you said, those people who are buying a house, they've got debt, they've got dependents, school fees, cost of living. These things are really important. So let's try not to deep dive, but let's talk about maybe the four key elements of wealth protection that we see. And we might go in reverse order on our list here. Because
I was going to say it's sort of a little bit backwards, but
yeah. So income protection insurance, because that's probably the one. If income protection and death cover, which is the second of the two that most people have some sort of appreciation about, but income protection. So what it is. So most of us, and I think it says this on our website too, that most of us are inclined to insure things like our cars and our homes and our contents, but the idea of insuring yourself or insuring your potential to generate an income for your household is sometimes put to the back. And I would argue that without your income, none of the best laid plans you put in place can actually occur. So income protection tends to be almost one of the primary wealth protection things that we really should be considering. So what is income protection? Exactly as it says, it's about protecting your income. It is not a lump sum, so it's not $500,000 lump sum in the event that you can't work. It's generally for short-term illness or injury that knocks you out of the ability to earn an income, and therefore it replaces, your salary like a salary. So on a fortnightly basis or a monthly basis, it replaces a proportion of your income while you're unable to work due to illness or injury, so that you can continue to pay all those things that we just spoke about.
I think people that have been around it probably understand, but for those that don't, it's not something that you can insure yourself above and beyond what you earn at the moment. It's to create a protection that's, in recent history, 75% of your income, and that's sort of dropping down to 60 or 70% as we speak. But it's just there as a first layer of protection, regular cash flow. That's what we all sort of crave and need. So again, in isolation, though, it's not the be all and end all. Like, it isn't enough. And I think that's the other issue, is people have, all of these things need to fit together. If you just have one of them on its own, people think, hey, we're all good, got life insurance or got income protection. Yeah, I'm all good. And there's so many events where that wouldn't actually help. Like, you've got income protection and you're not the person passes suddenly. That income protection is good for nothing. It doesn't kick in. It's gone. So it's there when you're alive but impacted, can't work for 6 months, 6 years, whatever it is, depending on your policy. A lot of people have policy, but they don't even know what it means. They don't know, I have to be off for 2 months or 3 months or 6 weeks or whatever it is. And they don't know how long it will pay them for. So even just being aware of what you got is probably just as important. Like, you need to know what you've got, and then you can plan around that too. So it's definitely horses for courses in that regard. You might know, look, if I can get covered for 5 years, I've got other things that would kick in and work for me from there. Maybe you need it for the next 25 years, though. It's very, very different for everyone.
Well, some of the things you're talking about there are the sort of the policy features. So how long does it take before it kicks in? That's generally what we call the waiting period. How much does it pays you? So 75% of your gross salary, that's the benefit. And then the benefit period. So how long does it pay for? Does it pay for a year, 2 years, 5 years, 10 years, to age 60, to age 65? All of those elements that you can choose, and sometimes it's dictated for people based upon occupation or health. But as you said, Ben, it's there to complement other areas of your situation. It's not the be-all and end-all. What I'd say with income protection is that if you earn an income and you're dependent on that income to function, you should at least be asking the question about whether, have I got income protection already in my super? If I don't, should I have it? If I should have it, how much should I have? And so that's probably income protection.
Probably just one thing on that, just before we move to the next one, is people often ask, what have I made redundant? And as far as I'm aware, I haven't seen one with this, but generally speaking, it's just for illness, basically, illness and injury. So you need to be off work due to illness, not that you get the sack or you get made redundant. It's not going to kick in for you there. And I think there's a bit of a misconception around that these things are basically all in place for health, basically, in really simple terms. And
that's why all of the things we're talking about generally require some form of medical underwriting. So another reason, well, again, we can go so deep into all these topics, but it's one of the reasons why insurance can be really complicated. It can be complicated to do yourself. It's complicated as financial advisors to get the right mix, and it's complicated by people's medical circumstances, which, again, is why you really probably should be seeking some advice around these areas of wealth protection. Did we mention that income protection can or is one of the only insurances that's tax deductible because it's there to protect your income? That's
and it's one of the ones that people, probably through lack of maybe understanding or planning, just whack it in their super. So just whack it in there. I don't have to pay it. Super will fund it for me. Which, maybe that's the right thing, but it's a bit of a hit and miss. It is tax deductible personally, so maybe you are better to fund it personally. Maybe it's better to go in super, and maybe you could put extra contributions into super to then pay the premiums. Again, they're all the little pieces that we form in our plans and our documentation to make sure you get it in the right spot.
Yeah, and this is the trouble we have when we talk about these things, is that there's so many factors, it's impossible to talk about all of them, and every single person's situation is unique. The ability to afford it, where to hold it, what the benefit periods is, what their health is like. It's complicated. So first of all, if you've got an income, you should be talking to someone about protecting it. All right, the next one, death cover, which is fairly self-explanatory, and it probably is the simplest of all insurances and wealth protection. And it really is, you have a policy on someone's life, you pay a premium for, in the event that person dies, the policy pays out. So if I'm insured for $500,000 of death cover in the event of my death, that policy is paid out. Now, That all sounds reasonably simple, but
It's never simple.
it's never simple. So like income protection, death cover has the potential to be owned inside super, outside super, to be owned by an individual or be owned by an entity. Like income protection, we see death cover used predominantly for those people in the accumulation phase of their life with dependents. So perfect example, myself, 43, I've got 5 kids. My family is reliant on my ability to earn an income and me to be about. If I was to pass away, I need to make sure I've got life insurance cover so that my family can continue, the kids can continue to go to school, and my wife can continue to live the
Online
life that she's accustomed to. What else do you want to add about life insurance or death cover?
I don't want to go too deep in the reasons because it sort of is pretty self-explanatory, but there is another part of it that people probably aren't aware of, is you don't always have to be not around to claim it. So again, this at risk of putting a figure on it, there's loosely 12 or 24 months. It depends on the policy, depends on if it's in super, out of super. But if people are deemed terminally ill, they do potentially have the ability to claim it early and then essentially get their house in order ahead of time, which might give them the option to do a few more things, or maybe at least the comfort of seeing it's okay. Like, no, they've got the policy, but if we can go through that process, get it paid out, start to clear the debt, start to sort of ease those burdens, it can make it easier for people if that time comes. So they don't have to, again, it's already done. Don't have to go through that claim process. It's already there. So there is some policies, and it's probably a little bit better than it used to be, I think, even in regard to that. So you can get your money paid out early if you are deemed terminally ill. So I think getting ahead of the curve on that. Sometimes people don't want to talk. Sometimes people and sometimes doctors don't want to put a time frame on people, but it's still worth exploring, I think.
Yeah. And one of the things to note there is that you can't, so the idea of being able to claim on insurance policies if you're terminally ill, you have to have the policy before you're terminally ill. So the idea of, this is why your health status is really important, because once you start to accumulate health issues over the course of your life, they can impact greatly your ability to get cover. So there's no point looking for life insurance cover once you've been diagnosed with a terminal illness. It's important to get these things in place. And that's, again, it's one of the things that people don't really like to talk about. It's like getting your wills established. It's something that, creates a bit of emotion, and thought of being without a loved one is not great. But these things are kind of never a problem until they're a problem. So if you can deal with them early and work out what cover you need, what do we need to protect ourselves, get it done, get it in place, get it done while you're in reasonable health, then you can wind it back or revise it in future years. But trying to get it later when you actually need it is almost, it can be very challenging. So get it early, work out what you need. And
that probably applies for all the different ones we talk about, but it's probably one of the biggest challenges we come across now in getting cover. And it's changed so much in the last 3-4 years especially, and people are much more open now to seeking assistance when they do have medical issues, which is a good thing. But from the insurance perspective, it's made it very difficult to get clean cover as such. So many people are reaching out to get support with things. It gets tacked onto their medical history.
Yeah. We haven't really talked about loadings, exclusions. That's probably...
We might loop back to that at the end once we work through the next couple. Otherwise, we'll go off on a tangent for a long time. Were you thinking TPD, the next one off there, or trauma?
No, let's go TPD next. Yeah. So TPD, we love our acronyms, or the industry loves acronyms, stands for Total and Permanent Disability Cover. So let's go straight off the website. TPD cover provides a lump sum. I should have said before that also life insurance is a lump sum as opposed to income protection, which is a regular income. TPD cover provides a lump sum if you become unable to work due to a permanent disability. This cover can help pay for medical expenses, pay debts, all the things that we spoke about earlier. So this is, I'm not dead. Potentially, if I am unable to work and I've got income protection, I'm potentially claiming on my income protection as well. But this is more, I can never work again. I need a lump sum to clear the debts I have, make modifications to my home to be able to accommodate my disability, and ensure that all the plans I put in place for wealth creation and looking after my family still stay in place.
It's probably one of those covers that people aren't as aware of, I don't think, but I've been through the process with a few people claiming in the last few years, and it's not a nice process again to go through, and you don't ever want anyone to claim on these things, but super important and fits in.
You know what's worse than that?
Not having it?
Yeah, he's having someone be permanently disabled and looking around saying, I hope they've got some cover.
Yeah, and this one I think pairs together with the income protection. Again, if you set these up correctly, you have the right levels of cover, you go, bang, I've got a lump sum payout, I've been able to clear my debts, I've got income protection tacking onto it for the rest of my working life or whatever it may be, and you've got them working together perfectly to give you comfort on that financial front.
Well, I think that people forget, because you think that you're bulletproof and nothing's ever going to happen to you, is that the last thing you want to be thinking about when you're dealing with a sort of a total and permanent disability or a long-term disability, the last thing you want to be considering is financial difficulty.
Yep.
This is the whole idea of wealth protection, is to make sure that considerations around money just aren't required. There's no need to be worried about, can I pay my bills? Can I continue to have the kids go to the school I want them to go to? If I've got the ability to, can we still travel? Can we do the things that we want to do? If you've combined a disability with financial instability, it's kind of the worst. It's the perfect storm.
Yeah.
It's the perfect storm. It's what we don't want, and it's really hard to wind people out of that situation. So there's where these wealth protection elements, insurances are super important.
And they fit just, I can say, the wealth protection plan, and these are just pieces of it. Again, we might work through one. I was thinking one of your clients from a few years ago who sort of had these set up correctly, and we managed, I think all 4 got claimed on across that period of time. So how they sort of integrate. So the fourth one there is the trauma cover, which I don't know if this is one of the newer ones to sort of become into the market. I know it's been around as long as I have, but it seems to be one that does get claimed on probably too often because of the fact that trauma cover essentially, I'll read just what we've got listed there, but trauma cover provides a lump sum if you're diagnosed with a medical condition or undergo a procedure outlined in your policy. This may include heart attack, major organ transplant, cancer, stroke, just to name a few. So as it sort of the name depicts it, it's one of those traumatic, generally sudden impacts on your health. So again, it's a lump sum payout, can't be owned in super, has to be paid personally, which probably has meant it's not as common because people don't necessarily like reaching into their pocket to have it, but it can provide people with a massive buffer. As I always think, it's just a buffer.
Yeah.
It gives you time.
Well, trauma cover, I think about some of the examples of clients of ours where they've had a major event like a heart attack or have been diagnosed with maybe potentially a non-terminal cancer, but they're not totally and permanently disabled. They haven't passed away. And in some instances, I've had a couple of instances where clients have had cancers that have been extremely impactful on them personally and financially with medical costs, yet they haven't been out of action long enough to sort of tap into their income protection. Trauma cover's there to provide that buffer, that lump sum. So upon diagnosis of that event, that condition, so a heart attack, stroke, cancer, a lump sum, whatever the sum insured that someone has, is paid. It's paid, and it can be an enormous support for people at a very difficult time. Again, as you said, it tends to be probably the more expensive of covers because it's not tax deductible. You have to pay it personally, so you can't structure it within super. But I think in balance with the others, like you said, in balance with the other covers, it forms a fairly important part of people's overall wealth protection.
Yeah,
and
the thing I like about it is it's probably one of the only ones that's death cover is pretty clear cut, but trauma is pretty clear cut in terms of here's a list of conditions. If you've got one, you're getting paid out, basically. And the doctor says you've got this, or you've had a stroke, or you've had this. You go to the insurance company and say, here it is, and they go, bang, paid out quick, clean, lump sum, which creates the buffer quickly. It just comes in quick. It's simple, gives people room to move. And I was thinking about trauma and how that sort of fits in with one of your clients who sort of went through it was almost the perfect, but you don't ever want to do it, but the perfect example of how they all fit together. So diagnosis of cancer, trauma payment, goes on to income protection for an extended period of time to the point where they couldn't work anymore, total and permanently disabled, go on to their TPD claim, sadly then pass away. So you literally roll you through all 4 of the covers. Again, getting that right at the outset with the setup.
As you're saying that, thinking about some of the questions that clients ask us about, am I doubling up here with cover? Again, one of the ways that if you're planning this right, you structure, again, we're going to go down a rabbit hole. A lot of these covers, you can have them what they call either standalone, meaning that neither one impacts the other, or you can have them linked, which means that as you claim on one, it gradually reduces so if you claimed on your trauma cover, it might reduce slightly your disability cover. If you claimed on the disability cover, it reduces slightly the death cover. All of that maybe improving the overall premium. So there's so many factors that go into putting this in place. As we said from the outset, people's other like their realisable assets. One of the things we take into account, like what other assets do people have that they could realise without having insurance that they're happy to liquidate or get access to. All of those things come into play when we're trying to calculate the optimum level of wealth protection for people. So how do we go about talking simply about topics? It's pretty hard, isn't it?
It probably just displays why people need advice on things. And I often say to clients, I think it's disappointing that people can't do more of these things themselves because it's got so convoluted, complex. And the scary thing is that probably seeing policies that people have set up themselves, how wrong it can go. And also, not to slag out any of these policies you see pop up on the 10 o'clock morning show, but when they're real life insurance or whatever they may be, a lot of them aren't doing the medical testing at the outset.
Or it is
accidental.
It's a questionnaire which then has a very broad general disclaimer of exclusions that pretty much make it impossible to claim upon.
Unless you get hit by a truck. They become pretty much a tragic accident only. So they might look cheap, but you really are getting what you pay for. And fortunately, not too many people die in that manner. It does happen. But for most people, it's an illness. It's a long, and generally, it's a long period of time that they're ill for.
Yeah, well, maybe on the death cover, like a term life policy pays in the event of death. An accidental death policy pays in the event of accidental death only. So that means not death by natural causes. That means, like you said, hit by a truck, hit by a bus. There's very few instances in that. I've seen policies like that where clients say, yeah, I've got a policy, I've got life insurance, and you look at the detail of it and it's an accidental death policy only. So be aware, and if in doubt...
There's nothing worse than thinking you've got something that you don't have too. Like, if you know that you don't have it, that you know what you've got and what you don't have. But for a lot of people, what they think they have and what they actually have is completely different. So that's, if you know and accept that that's what you've got, then power to you, that's fine. But if you think you've got something and you think, you know what, worst case, if something happens to me, the family will be okay, and then they're not, that's the worst possible outcome.
Yep. Have a plan, and talk to someone about it. All right, we're going to throw straight into a little bit more complicated area of insurance and protection around business. And I know you said to me last time, Ben, you can talk about this one because you're probably less to do with sort of business succession planning, buy-sell agreements and the like. So we're talking about wealth protection, and the first topic was personal wealth protection. One of the topics that we talk about a lot from a business point of view is business wealth protection. And you hear the term called buy-sell agreements or business succession arrangements thrown around a lot. And actually, when I put this topic down to begin with, I put buy-sell insurance. Buy-sell insurance is really just talking about how you fund a buy-sell agreement or a business succession arrangement. So what we know is that most small businesses, people go into business with their friends or their families, or they get involved with other parties. And one of the things that gets forgotten a lot is actually setting the parameters and the sort of guidelines to how those parties are going to operate in business should someone want to exit. So we know that people go their own separate ways from time to time. In business, there's lots and lots of ways that people can part company. So you might have a falling out with your business partner. You might decide to go your own separate ways amicably. Someone could die. Someone could become disabled. Someone could have, like we said before, a traumatic event and not be able to function in a business. They could do something that is, not kosher. They're, what's the word I'm thinking of, Ben? Something
illegal.
Something that's illegal, and you want to exit a relationship with that person. A succession arrangement or a business succession agreement or a shareholders agreement, there's another way of talking about it, is basically like a business will. It says, if in the event this happens, this is what we will do. And the way that relates to protection is that one of the most common things that we talk about with people in business is what happens to your business in the event that you die. Most people don't know that.
They just say, I don't know. My brother will jump in and help.
Yeah, my brother will buy my wife out and it'll all be fine. What a buy-sell agreement says is, if in the event of death of a business owner, it says, how's the business going to be valued? Who is going to receive the business? And how are they actually going to pay for it? So let me use the example of, let's imagine that you and I are in business, Ben, and something happens to me. So I pass away and you've got a couple of options. You either go, well, you're now in business with my wife, Kari, which you may or may not.
Seamless with transition.
Yeah, I'm sure it's a seamless transition. Or you've got to find a way to actually pay Kari out for my share of the business. Now, that in theory sounds pretty simple. We'll just have a chat and we'll work it out. In reality, like anything, when there's sort of death and divorce, if something's going to go wrong, that's exactly where it's going to go wrong.
Wasn't emotion. Like emotion clouds everything. So naturally, it's just that's at its absolute peak. It's the last thing you want to be thinking about, isn't it?
Yeah. So
business.
So having to make decisions about how do we value the business? How do I buy Kari out? Kari's emotional. She's just lost her husband. Actually, I don't really want to be in business with Kari. How's this going to work? If you've got a shareholders agreement that clearly states, in the event of death, we have a life insurance policy that's paid potentially by the business that simply funds Kari for her share or Jay's share of the business, and the remaining share or Jay's share then passes seamlessly to Ben. Everyone's happy. Kari receives her fair share of Jay's value in the business. Ben takes over the ownership of the business and there is no concerns. The idea of a buy-sell agreement is to actually set those terms out early on in the piece. So basically, when people start in business together, draw those agreements up. So spend the time, invest the money to actually go and talk to someone about having a shareholders agreement, a buy-sell agreement, agree on what we would do in the event of death, disability, illegal activities, underperformance. Put that in writing while everyone's happy and everyone's in agreement. So when you actually need to pull the trigger on funding someone out of the business, you've got clear direction around what it actually looks like.
It's this overlaying with the personal insurance stuff. It's just all about doing it when you can, like being prepared, doing it while your mindset's in the right spot to do it. It just saves so many hassles and impacts when things have gone pear-shaped. And life, we know life throws that at us. I've got a client at the moment who's on the back end of one of these buy-sell agreements being executed, and it's not what he wanted. It's definitely not what they planned for, but fortunately it's in place and ready to go, that the transition can happen and everyone knows where they stand pretty quickly. It's actually even smoother than I probably would have thought it would be. It's because it's laid out. It's just following the tick boxes, basically. It's very streamlined, and I think again, these things probably people don't think about when they enter business to start with. So having guidance in that area is pretty important. Most people just go in there, and I think you said last time, the first thing they think about is what the name going to be called. Like,
where can I get my business cards done? Yeah. I need some stationery.
It's the fun stuff. It's the sexy stuff. It's not this stuff. It's really not worth it. Yeah, I don't know. We sound so negative sometimes in terms of this, but things go wrong, and when they go wrong, it's bad. It doesn't just impact them for 6 months of their life. It impacts them and maybe even the generation to follow in the worst circumstances, because it has such an impact on the family emotionally and financially. It just lingers.
Yeah. Again, things aren't a problem until they're a problem. I've got a couple of examples of clients at the moment. We're not through death, but just through disagreement. People are going their own separate ways. And if a shareholders agreement existed at the outset that said, listen, if we choose to go our own separate ways, here's how we will value the business. Here's how we will fund the person that's departing the business. There's no argument. And if there is an argument, we just refer back to the document. And so, again, shareholders agreement, buy-sell agreement, whatever, however you want to describe it, it's about having documentation in place when you go into business with anyone that says, here's what we do in the event of exit of any party. And it ties I suppose the death and the disability part of it ties very closely into the wealth protection conversation we had before, because one of the difficulties that business have in the event that someone is to part is funding. Like if someone exit stage left of a business, but the remaining party simply doesn't have the funds to pay the estate or the partner of the deceased, the insurance provides that funding. So insurance provides that funding to ensure that there isn't a delay in the transfer of that business, and it's not putting anyone under undue financial stress. Everyone's happy and as happy as they can be in a difficult circumstance. the business can move on. So if you're out there and you're either thinking about getting into business with a family member, the other one, obviously I'm in business with my father, but we still treat our business relationship on commercial terms. And that is, we make sure we've got an agreement in place that lays out how things would look if we're ever in dispute or we can't make a decision. We refer back to the shareholders agreement. I can't stress it enough, and I think it's a very underdone element of people moving into business. Yes, it's a cost.
The cost, people get scared by the cost, but it's such a small cost for what the benefit. It's like we talked about earlier. You pay your income protection $1,000 a year. You protect yourself for $4,000 a month of income. You pay $1,500 a year to protect a car worth $20,000 that's going down in value. Like, it doesn't make, dollar for dollar.
You've got a $10 million business and you don't want to spend a few $1,000s getting the legal advice, the accounting advice, the financial planning advice to actually put it in place. It is, and I've actually used that analogy. I said a shareholders agreement is almost like an insurance policy. It's an insurance policy to make sure that future event is actually taken care of, and that there is less decision points that people can actually run into issues with. So again, if you're out there, you've got a small business and you don't have a shareholders agreement, or you don't know what we're talking about, you definitely need to speak to someone. You can come and speak to us. We're here and available to talk business succession planning, buy-sell insurance, as well as all of the personal insurances that we just spoke about. But as Ben has rightly said a couple of times, every topic that we're talking about is just one small part of people's own circumstances. I mean, the self-employed client, Ben, sure, they might need a shareholders agreement, they might need personal insurance, but they are just two small elements of their bigger picture, aren't they?
And that's the thing. I think people, we're probably all guilty of it. We're really good at looking at one item in isolation and doing something to address it. But there's all these factors either side of it. And think it from a physical point of view, you go to the physio, the chiro or whatever, and you got a sore back, but it's probably not your back that's the problem. Like, it's probably something around it. You've got weak glutes or something. I don't know what it is. Like, there's something around it that's not right either. So they all those things need to combine to make sure that you've got good health. Like, it's the same thing. Your financial situation is just like your body. Like, you can neglect one thing and all the others will suffer. All the other parts will suffer at some point. So again, it sounds a bit cliche, but it really is the case, and we've seen it so many times over that you need to have all your ducks in a row.
Yeah, we were talking about actually doing another little intro video. We actually got our video production guru, Luke Massey, coming in later today. We're producing a video about people's first experience with seeing a financial advisor. And one of the things you note is that most people have a couple of areas nailed. They've got a couple of things they do really well. And the initial conversation with a financial advisor should be as much them confirming the things that you're doing really well, but then being able to identify those things around the outside of that you maybe you've had the blinkers on, haven't been focused on, and that need to be tied in to make sure that you've got that, I don't know if it's jargonistic, but that holistic plan that covers off on all elements, that sort of jigsaw puzzle of every element of your situation, cash flow, taxation, wealth protection, wealth accumulation, estate planning, all the above. They're so important, and that's why we've got a podcast, Ben. That's why we talk about these topics, and hopefully it resonates.
Hopefully someone listens.
Fingers crossed. I'm sure there's someone out there that
mum and dad.
Well, yeah, my mum will be doing reviews for me. I'll make sure that she does. Have you got anything else you want to talk about?
I don't think there's anything jumping out at the moment. I think, again, those are probably sort of topics that are just not the sexy stuff still, but it's just so important. And I think we say it so many times, we see this stuff happen. Like, we see these things where they're not done properly, and we also see where it's done properly and the comfort it can give people. So I'd much prefer to be dealing with a claim on a insurance plan that's been set up and we know is going to work than to be trying to piece things together, and you end up just sort of papering over the cracks to try and get people through at times when they haven't done it properly. And it's pretty sad. Like, it is. I don't want to throw too many examples and things in there, but I had a client who we engaged with them for a period of time and had things set up, and they sort of just drifted away from us at a point. And through that period, some of their stuff, they just weren't reviewing it. And then sadly, he ended up passing away very young, and then they were sort of half cooked in terms of what they could, where things were at. So again, I think that review of things is important. Like it's not a set and forget thing. I think I say to the clients, I said, this is the most insurance you should ever need, and we should be trimming away at it over time if everything else is working together. If we're building wealth, if we're building super, non-super wealth, we're reducing debt, all of the other factors, if we've got our plan right, the insurance should pretty much start at its peak and it should be coming down over time. Not very often we should need to increase it. Again, there's times where we will, but generally we should be nibbling away at that cover to bring the cost down and eventually get to the point where you're so flushed from an asset perspective and passive income perspective, you don't need any insurance, but there's a period in everyone's life where they need it. Not many people could say they never needed insurance.
Yeah. It's scary sometimes, the amount of people that are prepared to run the gauntlet.
I just don't think they're even aware. Some people, you sit there and you go, if you die, this is what will happen to your family, and they'll just look at you and go, "Yeah, I'll be dead anyway."
Yeah, so that's my least favourite response to
people say it. They get their wife sitting 3 feet from them, and they say it. It scares me. Like I don't know.
Yeah, I don't understand that either.
But again, we've got those clients where every year we'll bring it up and say, "You need to think about it. You need to think about it," and you just got to keep chipping away at it. But I think most people are aware they need something.
Yeah. All right, let's call it quits, Ben.
You got to go to the physio and reattach your hamstring too much.
Yeah, I've got 18
gymnastics.
18 minutes before I get there. Maybe I'll get Megan in on the podcast one day and she can talk to us about physical health and how it relates to
health as wealth.
That's it, people's financial situation. All right, thanks, mate.
Thank you.
We hope you enjoyed today's episode. If you're keen to understand more about how financial advice could benefit you, follow us on Instagram, Facebook, and Twitter at BurkeBrittonFP. Or Google Burke Britton Financial Partners. Check out our client reviews, testimonials, and make a time to meet one of our certified financial planners by clicking Book Now on our website. Thanks for listening.
Any information contained in this podcast is of a general nature only. No account was taken as to the objectives, financial situation, or needs of any particular person. Therefore, before making any decision, listeners should consider the appropriateness of any information with regard to their particular objective, financial situation, needs, and seek independent advice from a licensed professional specific to their circumstances.
All right, hit it.
That translates to, don't be a moron and act on what some random person says on a podcast. Take personal responsibility. Do your homework. Ask questions and speak to an actual human that knows what they're talking about before you do anything. PB Financial Solutions Proprietary Limited, trading as Burke Britton Financial Partners, are authorised representatives of AMP Financial Planning Limited, AFS, licence number 232706.